So if you can go find 4% private money, I'm going to tell you to go take the 4% private money. It's going to be much better for you. But just keep it in mind that, if something were to happen to fall through with that friend or family, you're not going to be able to just readily go out and find something that's going to be as competitive.
What is up, YouTube? Matt McKeever here, and in today's video, we're going to be talking about the different types of private lenders. Yes, there's actually more than one type of private lender. In fact, there's a lot of different common avatars we can ascribe to the different types of private lenders we see on a regular basis when it comes to real estate investing. So Josh and Aaron from the Findlay Mortgage Team are going to walk us through really just all the different private lenders that they deal with on a regular basis, as well as share some perspective towards what sort of deals you should be reaching out to those private lenders for. Let's jump into today's video. What is up, YouTube? Matt McKeever here, and we're back with Josh and Aaron. Hey guys, how's it going? And today we're going to be talking about the types of private lenders. And I'm really glad that we're going to be shooting this video because way too often I get generic questions like, what's the industry standard for private lenders? And I'm like, there isn't, that's the whole point. So let's talk about, we can probably group some lenders into different categories though, right? When we're talking about private lending?
Yeah, for sure. So we get a lot of questions, as you said, what's the rate for this specific thing? And it's like, well, there's a handful, what a lot of people don't understand is there's a handful of different types of private lenders out there for different types of real estate. So whether it's, we're going to go through them, but the mortgage investment corporations, mom and pops, hedge funds, REITs, and they all have a different place in the market in regards to investments. So real estate in general, if you don't know, is one of the largest investment vehicles on the planet. And a lot of people don't really see past the residential, you and me or somebody else purchasing a house. There are corporations out there who have businesses to specifically invest in different niches in real estate. And some of those niches are the private market. So, when we're looking for loans, not only will we find a mom and pop who has a few $1 million to put out, we'll also have institutional private lenders who are looking at maybe larger commercial things. So what we wanted to do is we wanted to break down who those are, what they do, how they work, and to give you guys a little bit of insight about the private market and maybe a little bit of knowledge about how that works and how we source some capital.
And some potential investment opportunities for you guys as well too, because some of them do accept investments from lenders out there or investors out there, so it could be a good opportunity for you guys as well too. But starting with the first one, let's start with a MIC. So MICs are a mortgage investment corporation. They are essentially the institutional lenders on the private side, and MICs have been around for a really long time. I think they actually go back to somewhere in the 80s, but the government realized that there are ways out there to publicly source and fund mortgages, and one of the ways to have that is a MIC. MIC takes investments from public investors, people who want to be able to put money into real estate without being a landlord or a private investor themselves. You can invest your money into a MIC and they will pool that money into different pockets of investments, whether that's residential, office, industrial. They're really good at diversifying, and that's part of what allows them to be as competitive as a lender as they are. But from your side of that, if you're able to invest your money, they offer a pretty hefty 6 to 8% return on average, and some of them out there even do go up into the 10 to 12% depending on how aggressive they are and how much money you potentially put in. So something to keep in mind for investors out there, like I said, don't want to be a landlord or don't want to be a private investor themselves.
Yeah, some people may think private lending is the Wild West. So people just kind of do what they do. They sneak around. They'll invest here. They'll invest there. They are really savvy at what they do. Well, this gives you an opportunity to be able to invest with a federally regulated financial institution that has audited financial reports, complete transparency. So if you're looking for something that is I want to say safe, but I'm not saying it's not the wrong word, but something that has transparency. So something that you can show, they can show you the portfolio that they have, the return that you're making. It's a lot like your investment portfolio would show you a quarterly report as to how your investments are doing. If you want to add some sort of piece of that to your portfolio, it's a great option to have. We specifically use mortgage investment corporations for private funds. So they are scattered all across Ontario. They're usually specific to a certain geography that they want to stick to and a certain niche market of real estate they want to invest in. They are regulated by their offering memorandum to their people or to their investors. There are a handful of things that they specifically are and aren't allowed to do. One is that you have to have at least 20 people invest in it. No one person can own more than 25% of the shares. All of it has to be in Canada, so they can't borrow it in the States. And obviously they have to have their annual finances audited by an institution. They're a great alternative to maybe less expensive private money. They specifically are running a company and they cross their T's and dot their I's because they could possibly package those deals up and sell them institutionally at some point or offload them to a B lender or something like that. So they are more stringent in regards to their underwriting parameters, but they have access to large pools of private capital. And we source them for like our small commercial stuff and our large commercial stuff.
And I think like when we're talking about mixed mortgage investment corporations, like everything with private lenders, it's really important that we understand that, again, while this is a category, each MIC is very specific to itself, like Josh was saying. So whatever they've outlined in their memorandum is really going to dictate what sort of business they can get into. So it's important when we're reaching out to, say, a mortgage agent or a mortgage broker, that we make sure that they've got multiple contacts in that space, right? Because if they've only got one MIC that they're working with, that MIC's going to likely be restricted to a geographic area and one specific niche of real estate.
Yeah, there's going to be some MICs out there who, have their sites, and it all depends on who's running the MIC as well too, and what their background experience is. So there's MICs out there who are, they like the land development or the land acquisition, and then there's some MICs out there that focus a lot more on like residential deals and smaller res deals, and then there's some MICs out there who like to get a little bit into maybe more the construction side of the financing as well too. So for us, it's about finding what the borrower needs and then being able to place them with the appropriate lender who's going to have the services to fit that.
The great thing about working with a MIC is you're dealing with professionals who are focused on a very specific type of real estate. So if you're looking for an expert opinion on a specific deal, they would be the ones who would know, because it's what they do day in and day out. They don't look at one thing that they're not doing. They're focused specifically on, say, apartment buildings. So if you went to them, they would know everything there is to know about apartment buildings, and they'd be able to tell you very quickly whether the value is what it is, whether the deal is doable, what rate it is, and they can be very competitive in their space because they dominate that space. Which, if you're going to deal with a private lender, you might as well deal with somebody who knows what they're doing.
And the MICs can get creative as well too. So, like, one of the great things about a MIC too is, they're able to partner up with either another MIC or another investor to be able to create a unique product for the borrower. So one of the products that we are able to create, and we've talked about, is our tiered lending product, where a MIC that we worked with actually went out, sourced another investor, and was able to put together that product for us to give to our investors. So they can be flexible in their own ways, similar to an individual private lender.
One of the key reasons from an investor perspective why somebody would use a MIC, you can use your RSPs and your TFSA, so registered funds, into a MIC. So that return on your investment, you're making about 6 to 8%, as Ehren said. It's tax-free money. It's a great way to grow your money if you want some exposure to real estate without actually owning real estate. I know all of you own real estate or you're buying real estate, but it's a great way to make passive income tax-free. So a lot of people take advantage of that and make their money work for them by investing in MICs. I guess the next type of lender we want to talk about is the mom and pop lender. We call them the mom and pop lender, but somebody who's maybe made their money in real estate or made their money in business or somewhere else, and they understand real estate and they want to invest their capital into real estate. These are basically our bread and butter. We love dealing with these people specifically because the private solutions that we can come up with these people are way above what any institution will allow us to do. As long as it makes sense and the risk threshold isn't surpassed, we're able to create some really flexible lending products. Specifically, these rates for mom and pop lenders are higher. They're usually higher than what a MIC or federally regulated institution would offer, just because they're doing all the work. They expect a return on their money. We're usually looking at least double digits for a mom and pop lender in regards to rate and fees. But they are solutions-based lending, and a lot of them deploy their capital by themselves. So they'll analyze the deal by themselves. They'll make a decision by themselves. They'll pick where it is. and they will help us help you along the way. So mom and pop lenders make up a huge part of our specific group of lenders.
Yeah, the best thing about these lenders is because it's usually an individual or maybe two individuals, we're able to build a personal relationship with them. And there's a few lenders that we've been using and our partner Scott's been using for 80 to 90% of his career. So having that experience and that previous vetting with these lenders, we're able to maybe push them a little bit further into what they aren't uncomfortable with some other people, because they know that we brought them the deal, that we've done our vetting, and when we push them to that, we're kind of personally vetting our clients as well too. So the biggest benefit is being able to leverage our personal relationships and be able to create those flexible solutions for our clients, and to be able to push the lenders to service the clients in their niche products. So
unlike actually mix, mom and pops don't have a minimum loan amount, and they aren't regulated by what they can and can't do. So if they would like to put all of their capital into a single deal because they want to do that, they can do that. There is no minimum requirement for them to be able to allocate funds however they would like, kind of thing. And also the great thing about it is they usually travel in packs. So as you know, your network is your net worth, and the majority of people who put large amounts of money into real estate have friends who put large amounts of money into real estate. It's very easy to syndicate deals with people who are sophisticated investors and who understand the market. So dealing with these types of people allow us to maybe put larger deals together because they have the connections and network with other people to be able to make those deals happen.
So another vehicle and type of private investment that we want to talk about is a REIT, so a real estate investment trust. This is a company that owns operating and income producing assets, so apartment buildings, office spaces, or other residential type properties as well too. The REITs are modeled after a mutual fund, but still slightly different. So it does utilize a large pool of investors' capital that can be invested from the outside, and they will go in and invest in certain areas. And you can actually trade on some REITs as well too. So if you're looking, again, another option, if you're looking to invest in real estate but don't quite feel comfortable being a landlord or a private lender, similar to a MIC, this is another type of investment vehicle that you can invest in and help have a very stable, maybe not as volatile, but a stable growth throughout the years. And there's some very strong REITs out there. Like Cap REIT is a very strong producing REIT with a pretty high yield.
And so then I guess just like building from the investor perspective, I think a lot of new investors don't realize we can actually borrow from those REITs as well, right?
For sure, yeah. So if we're looking at large projects, for example, we're looking at maybe like $10-20 million projects. Sometimes they need capital to be able to move forward, and maybe a REIT would be some sort of mezzanine lender, meaning they would offer an injection of capital, but they would also want some sort of equity position in the property as well on the completion of the project. So depending on the size of it and the type of REIT, usually REITs are looking at exit strategies. So if, for example, someone's building a large development and the REIT, it fits their specific portfolio, they might have invested interest in being able to bring that to completion. So if we're looking at large loans, sometimes we approach REITs to be able to structure the final bridge loan or the takeout financing at the end of a loan.
And REITs don't have to be a large corporate structure as well too. We're actually dealing with a community type development, and we met with a gentleman the other day, and he owned his own private type REIT. So sometimes these private investors grow to such a level where they can start accumulating properties, and we can leverage those private REITs to be able to come in and either inject cash, like Josh said, through mezzanine financing, or simply come in and just purchase the product as an exit strategy if it's something that they find that fits their portfolio. So depending on what our clients are looking for, REITs can be useful in a handful of ways. So again, something else to add to the portfolio of investments out there, and another way for investors to make some return on their cash in the real estate market.
The final thing we want to talk about, it isn't talked a whole lot about real estate, but hedge funds. There are a handful of different hedge funds out there that do specifically invest in real estate. They invest mostly in REITs. And then the difference between a hedge fund and basically a mortgage investment corporation or a REIT is that they aren't really regulated in regards to the amount of leverage they're allowed to use. It is more risky to invest in a hedge fund, but there are a handful of them out there that invest heavily into the real estate market. Specifically, these types, most brokers don't deal with hedge funds. If you're looking at very, very large deals like apartment buildings downtown Toronto, you may approach a hedge fund to try to get some sort of financing or part of financing if they want some exposure, like downtown Toronto. We do see a handful of the Maple Leaf buildings. They source funds from pension funds and from hedge funds to be able to get the capital to build. Those buildings cost $300 or $400 million to build. So when the banks don't want to lend, you start looking at private finance. I know it's crazy. It's crazy to think that corporations or loans that size would be private, but believe it or not, a lot of the investments, say the teacher's pension fund, for example, they have a lot of money invested in private real estate. So something to think about. A lot of people maybe just don't think about that specifically as an avenue for brokers, but we sometimes have to, depending on the size of deal you're looking to. And the last one we want to talk about is unicorn money. Money that exists, but it doesn't exist. If your uncle's going to give you 4% money, it exists, but it really doesn't exist in the market. So we have a lot of people saying, how come this rate is the way it is? There is cheap money out there. It does exist, but for people who love you.
Yeah, and I think that's the big distinction that needs to be understood here. All the lenders we talked about up until unicorn financing, they're focused on risk and reward. Oftentimes when we're talking about friends and family, they want to support you. So as long as they believe that there's not a great risk of them losing everything, they're not necessarily considering the reward side of the equation. They're just like, okay, my GIC pays this. I guess if you can beat it, let's do it, right? Yeah. As long as they trust and really believe that you're not going to risk and lose all their money.
And we're not trying to deter anybody away from trying to find other, friends and family who want to lend them money. I mean, we have your best interest at heart. So if you can go find 4% private money, I'm going to tell you to go take the 4% private money. It's going to be much better for you. But just keep it in mind that, if something were to happen to fall through with that friend or family, you're not going to be able to just readily go out and find something that's going to be as competitive. So, we're not throwing our rates and terms around because we're trying to make money on you guys. This is just where the industry standards are, away from that friends and family discount. So I mean, like I said, we've had a few investors that have come to us and looked for private financing, and we've had some deals set up, and then last minute, they say, hey man, my uncle is giving me some money and it's a much better rate, and that's fantastic. Congratulations, take that money and don't tell anybody else about where you got it from. Save that money for yourself. But it is out there, but we just want to try to set some expectations. If they don't have that money, or if you've gotten that type of loan in the past, don't have that rate and fee expectations set in your mind. It is going to be much different when you move into the true private world.
Yeah, and I think using the term unicorn is perfect to describe it, simply because this isn't going to be a scalable solution. So you might be able to do this deal or the next deal or the first 5 deals, but at some point in time, if you continue to scale and grow your portfolio, you're eventually going to hit that upper limit of what the bank of uncle or mom and dad can fund you with.
Agreed. Yeah, agreed. Yeah, no, I hope that this video specifically gives you a little bit of insight and knowledge as to where we source our capital and how maybe some different types of capital can work for your projects. Again, if you guys do have any questions, feel free to reach out to Ehren and I. We'd be happy to discuss anything that we've said in these videos today.
Awesome. Yeah, thanks guys. And again, all their contact information is linked in the video description down below. So make sure you jump over and ask questions, because it's a lot easier to help people at the start of the journey rather than the day before closing, right?
For sure.
Yep. You're definitely not getting unicorn money 2 days out from closing, so.
Thanks again to Josh and Ehren for taking the time to shoot this video. If you guys got value from this video, what I need you to do is smash the like button, hit the subscribe button if you're new to my channel, and otherwise let us know, what other questions do you have about financing your real estate deals? Let us know in that comment section down below. If you want more great videos on financing your real estate transactions, watch out these videos with Josh and Ehren there. Or if you just want other great Canadian real estate content, check out this playlist right here. I'll see you guys in the next video.